Welcome. In this video, we'll explore the preparation of performance reports, a crucial part of performance management system. Whether you're in a for-profit or not-for-profit organization, understanding how to measure, evaluate, and report performance is essential for achieving organizational goals. We'll break down the key concepts, steps, and types of performance reports and show how they fit into responsibility accounting. By the end, you'll know how to analyze these reports and use them to drive. Performance management is a cornerstone of management, accounting for both profit and non-profit entities. It's a structured process that guides organizations towards sustainability. The system typically involves 4 stages: establishing the right organizational structure, delegating control, and identifying responsibility centers, setting performance measures and targets, and finally, reviewing performance using tools like KPI dashboards. For nonprofits, the focus shifts to value for money (EMFA). Well-functioning performance management system relies heavily on a capable information system. This system must be able to record and report performance-related information accurately and efficiently. Without reliable data, it's impossible to measure progress or identify areas for improvement. Information systems serve as the backbone for collecting, summarizing, and distributing performance data across all levels of the organization, ensuring that decision-makers have the insights they need. Responsibility accounting is all about holding individual managers accountable for specific costs, revenues, or assets. It's an information subsystem within the broader performance management framework. This approach works best when authority is delegated, but it can be adapted to any organizational structure. The key idea is that managers should be evaluated based on the items they can control. This ensures fairness and encourages managers to focus on optimizing their areas of it. Performance report is a document that summarizes the outcome of an activity or an individual's work. It typically compares actual results to budget or standards, highlighting variances. When unfavorable variances are found, the report prompts action. For example, a project manager might receive a report showing cost or time overrun, while a city council's annual report might detail the efficiency and effectiveness of public services. The baseline used for comparison is critical. Performance reports are central to responsibility accounting. They are issued at regular intervals to inform managers about deviations from budgets. These reports not only compare budgeted and actual results, but also show how well managers control changes in activity. Reports typically flow upward in the organization, with each manager receiving detailed information about their own unit and summary information about units under their control. This structure ensures that both lower-level organizations use performance reports for several reasons. First, they focus attention on issues causing poor performance, bringing them to the attention of managers and employees. Second, they help quantify and prioritize issues, enabling decision-makers to address significant concerns promptly. Third, performance reports foster communication, encouraging discussions between managers and their team. Additional benefits include benchmarking, resource planning, enhancing business performance. The specifics of performance reporting may vary between organizations. The preparation process generally follows a sequence of common steps. These include understanding the user's needs, establishing objectives aligned with organizational goals, adding an executive summary, conducting a detailed performance assessment, designing an effective layout, and cross-checking details for accuracy. Each step ensures that the report is relevant, reliable, and actionable, ultimately supporting better performance. First step in preparing a performance report is to clearly understand who will use the report and for what purpose. Reports are often written for senior management, but they are also valuable for middle and low-level managers. By considering the needs of all potential users, you can ensure that the information included is relevant and detailed enough to support effective decision-making at every level. After identifying the audience, the next step is to establish objectives for the report that align with the organization's vision or mission. This involves selecting critical success factors, CSFs, and key performance indicators, KPIs, that reflect the organization's goals. By aligning the report's content with these objectives, you ensure that performance measurement supports the broader strategic direction of the organization. Executive summary provides a concise overview of the report's key findings and recommendations. It acts as a snapshot, allowing busy managers to quickly grasp the main points before diving into the details. A well-crafted executive summary highlights the most important trends, results, and issues, making it easier for decision-makers to focus their attention where it's needed most. Core of any performance report is the assessment section. Here, each business segment or responsibility center is evaluated using relevant KPI and metrics. Performance is typically compared against benchmarks or industry averages, and both cross-sectional and time series analyses can be included. This thorough assessment helps identify strengths, weaknesses, and areas for improvement, providing a solid foundation for action. Performance reports can include a variety of information types. Financial data such as sales, profits, and costs are common, but non-financial data is equally important. Quantitative non-financial data might include sales, volume, or number of complaints, while qualitative data covers aspects like reputation, customer satisfaction, and staff morale. Including both financial and non-financial information provides a more complete picture of organizational performance. Non-financial performance measures are critical for long-term success, especially in non-profit organizations. While short-term financial gains can be achieved by cutting quality or innovation, this often leads to long-term problems. Non-financial data, such as customer satisfaction or staff morale, can be harder to quantify but are essential for sustainable performance. Efforts should be made to convert qualitative information into quantifiable data for effective communication and comparison. Well-designed report layout helps users quickly understand key information. Visual elements like tables, charts, and graphs make it easier to spot trends and important figures. Narrative commentary is also crucial as it explains the significance of the data and highlights any issues or causes. Together, visuals and narrative ensure that the report is both informative and easy to interpret. Accuracy is vital in performance reporting. All details included in the report should be cross-checked to ensure reliability. Proofreading is especially important if the report will be used externally. Reliable data builds trust and supports sound decision-making, while errors can undermine the report's value and credibility. There are several types of performance reports, each serving a different purpose. Common types include earned value reports, which integrate scope, schedule, and cost; forecasting reports, which estimate future performance; progress reports, which track completed work; status reports, which provide a snapshot of current activity; trend reports, which compare performance over time; and variance reports, which highlight differences between actual and planned progress. Choosing the right type depends on. Earned value reports are powerful tools that integrate scope, schedule, and cost performance using earned value management techniques. These reports are often included as part of status reports and help organizations track whether projects are on track in terms of both time and budget. By providing a comprehensive view, they support better project management and resource allocation. Forecasting reports estimate what is expected to happen in the future, including anticipated performance and resource needs. These reports are essential for proactive planning and help organizations allocate resources more efficiently. By predicting future trends, managers can make informed decisions and prepare for potential challenges before they arrive. Progress reports focus on what has been completed since the last report. They are useful for tracking development and ensuring that projects stay on schedule. By regularly updating stakeholders on progress, these reports help maintain momentum and accountability throughout the project lifecycle. Status reports provide a snapshot of an activity or project at a specific point in time. They capture the current state of scope, time, cost, and quality, making them especially useful in project management. Status reports help managers quickly assess whether a project is on track and identify any issues that need immediate attention. Trend reports compare performance over different periods, such as monthly, quarterly, or annually. By analyzing trends, organizations can identify patterns, spot emerging issues, and make data-driven decisions. Trend analysis is vital for long-term planning and continuous improvement. Variance reports highlight the differences between actual and planned progress. These reports are essential for identifying where performance is falling short of expectation and for taking corrective action. By focusing on variances, managers can quickly address problems and keep projects aligned with goals. Beyond traditional financial reporting, several sustainability-oriented frameworks are relevant for strategic performance management. These include the Triple Bottom Line, Global Reporting Initiative, ESG reporting, and the Integrated Reporting Framework. Each framework expands the scope of reporting to include environmental, social, and governance factors, supporting a more holistic approach to value creation and accountability. The Triple Bottom Line Framework broadens the focus of performance reporting beyond financial results. It emphasizes the impact of business decisions on profit, people, and the planet. By considering social and environmental outcomes alongside financial performance, TBL encourages organizations to pursue sustainability and long-term value creation. Global Reporting Initiative provides widely accepted sustainability reporting standards. Organizations use GRI guidelines to disclose their environmental, social, and economic impact. By following these standards, companies can enhance transparency, build trust with stakeholders, and benchmark their performance against global best practices. ESG reporting focuses on environmental, social, and corporate governance data. Its main purpose is to improve investor transparency and inspire peer organizations. By disclosing ESG activities, companies demonstrate their commitment to responsible business practices and attract stakeholders who value sustainability. Integrated Reporting Framework, developed by the International Integrated Reporting Council, provides a holistic view of how an organization creates value over time. It covers strategy, governance, performance, and prospects, integrating both financial and non-financial information. This approach helps stakeholders understand the full picture of organizational value creation. Value creation is a central concept in integrated reporting. It's not just about financial gain. Value is generated through a combination of financial, manufactured, human, natural, intellectual, social, and relationship capital. The interplay of these capitals drives sustainable success and long-term growth for organizations. Consider an example. If an engineering department invests in automation, the performance report will reflect the impact, such as reduced variable costs due to fewer man-hours. Budgeted reports would show lower expected costs, and management could then compare actual results to these expectations. If efficiency or profitability drops, upper management can discuss corrective action with the department manager to address unfavorable variances. Once performance reports are prepared, the next step is analysis. Senior managers or experts review the data, both quantitative and qualitative, to identify trends, strengths, and weaknesses. The analysis should be structured, starting with goal setting and ending with an action plan. Setting a clear timeframe for analysis, such as monthly or quarterly, helps track progress and spot trends over time. Timeframes are crucial in performance analysis. Whether you're reviewing monthly, quarterly, or annual reports, consistent timing allows you to identify trends and measure progress accurately. Regular analysis ensures that corrective actions can be taken promptly, keeping the organization on track toward its goal. When analyzing reports, look for patterns that align with the analysis goal. Document trends, pay attention to critical issues, and summarize findings. This process helps managers focus on what matters most and ensures that resources are directed toward areas with the greatest impact. Final step in performance analysis is to develop an action plan based on the report's findings. This plan should address identified issues, set clear objectives, and outline steps for improvement. Action plans turn insights into results, driving continuous improvement across the organization. Recap: responsibility accounting involves collecting, summarizing, and reporting financial information where managers are held accountable for specific costs, revenues, or assets. Performance reports aggregate departmental budgets and summarize them for management, supporting informed decision-making and accountability at all levels. Performance reporting offers numerous benefits, including benchmarking, resource planning, enhanced business performance, improved communication, and preparation of external reports. These advantages make performance reports a vital tool for organizations striving for excellence and continuous improvement. Despite variations between organizations, the process of preparing performance reports generally follows a sequence: understanding user needs, aligning with objectives, summarizing key points, assessing performance, designing effective layouts, and ensuring accuracy. Following these steps ensures that reports are useful, reliable, and actionable. Organizations can choose from various report types: earned value, forecasting, progress, status, trend, and variance reports to record and evaluate performance. Selecting the right type depends on the specific evaluation needs and the nature of the data being analyzed. In addition to financial reporting, sustainability-oriented frameworks like the triple bottom line, GRI, ESG, and integrated reporting are increasingly important. These frameworks help organizations report on their broader impact and align performance management with global standards for sustainability and value creation. It's essential for organizations to set clear timeframes for performance analysis. Whether monthly, quarterly, or annually, consistent timing helps track progress, identify trends, and ensure timely corrective action. This discipline supports continuous improvement and strategic alignment. Internal performance reports are highly flexible and can take any form that management chooses. Unlike statutory financial statements, these reports are voluntary and tailored to the organization's specific needs. This flexibility allows for a more relevant and effective performance management process. Non-financial performance measures are just as important as financial ones. They should correspond with the organization's aims and help address the limitations of purely financial metrics like ROI. The most appropriate non-financial measures vary depending on the organization's nature and objective. Qualitative information, such as enthusiasm or empathy, is often referred to as a construct and can be challenging to measure directly. However, it's important to make efforts to convert these constructs into quantifiable data for effective communication, assessment, and comparison. This process enhances the usefulness of performance reports. Performance reporting is not a one-time activity. It's part of a continuous improvement cycle that involves regular measurement, analysis, and action. By consistently reviewing and updating performance reports, organizations can adapt to changes, address challenges, and pursue ongoing excellence. Summary: preparing and analyzing performance reports is essential for effective performance management. By following structured steps, using the right types of reports, and integrating both financial and non-financial data, organizations can drive better decisions, foster accountability, and achieve their strategic objectives. Remember, performance reports are more than just documents. They are a powerful tool for continuous improvement and organizational success.